Welcome to Notes Payable, Installment Note. By the end of this ACLET, you should be able to account for an installment note payable. By the time you're using this ACLET, you should know that in accounting, the word payable means that a company has the legal obligation to pay a certain amount to another company or person. Also, you should be very familiar with accounts payable, amounts that a company has the obligation to pay to suppliers or vendors. So what's the difference between an account payable and a note payable? The difference is interest. Accounts payable generally do not involve interest. Late fees or finance charges sometimes, but not interest. A note payable always involves interest. Here's an example of a note payable. Assume that you're the accountant for ABC Inc. and that ABC has just bought a car from Deli Enterprises and now has a legal obligation to pay $5,000 to the auto dealer. First, notice the title of the document is Promissory Note, not Note Payable. This is because ABC's obligation to pay is Deli's right to receive. The same piece of paper is a note payable to ABC and a note receivable to Deli Inc. Second, promissory notes come in many varieties, but we'll focus on just one type, which is sometimes referred to as an installment note, which means that part of the principal and interest are due in installments, a series of payments. If you have a car loan or a mortgage loan, you're probably very familiar with installment loans. The terms of our note require monthly payments of $148 each every month for 3 years. These payments will include interest at 4%. Let's get started on the journal entry to record ABC's buying a car by signing a promissory note on December 1st. What accounts are affected? Automobile and note payable because we, ABC, owe Deli Inc. as we drive the car off the lot. Automobile is an asset, increases on the left. Our asset just increased, so automobile will be on the left side of our entry. Note payable is a liability, so increases on the right. Our liability, the amount we owe, just increased, so note payable will be on the right side of our entry. Assuming that we paid no cash when we bought the car cost us $5,000 and we owe $5,000. This is the face amount of the note. The next transaction related to our note will be at the end of December when we make our first monthly payment as promised. We know cash will be affected because we're making a payment to Deli, and since our cash will be decreasing, it will be on the right side of our entry. Interest expense will be affected because by December 31st, we've borrowed $5,000 for a month, so we've racked up some interest expense. Interest expense is an expense, increases on the left, it's increasing as usual, so we'll end up on the left side of our entry. And we have a third account affected because every time we make a payment, we'll be paying off a part of the note itself, part of the $5,000. So note payable is affected. It's a liability, increases on the right, but we're paying it down, so the liability is decreasing. Note payable will be on the left side of our entry. We already know the amount we have to pay. The promissory note said that we have to pay $148 every month, but we'll have to calculate our interest expense. We'll use the interest formula, principal times rate times time. The principal amount is what we owe, $5,000, and the interest rate comes from the promissory note, 4%. But the 4% is an annual rate, and we only incurred interest for 1 month. So our time factor is 1/12, 1 out of 12 months in a year. Our interest expense is $16.67, but to keep the numbers easier to read, we'll round to $17. To figure out how much we are paying down on the note, take our payment of $148 and subtract the $17 that goes to cover the interest expense. Turns out we paid down $131 of the $5,000 that we borrowed. This $131 that we paid down on the note will be important next month. The second payment on our note will be made on January 31st of 2026. The same accounts are affected with each monthly payment, so debit interest expense and note payable and credit cash. Once again, we already know how much we're paying, $148. And again, the next thing we have to do is calculate how much interest expense we incurred during the month. We'll still use the formula, principal times rate times time, but there's a little twist this time. We no longer owe $5,000 because we paid down our debt by $131 in our last payment. So we have to do some math to get the principal, the amount we owe. $5,000 minus $131 is $4,869. Our interest formula is $4,869 times 4% times 1/12, or 1 month. Our interest expense is $16. Again, this is rounded to the nearest dollar just to keep the numbers easier to read. The payment of $148 minus interest expense of $16 leaves $132 to pay down the note. Because each payment reduces our principal, the interest expense will be less and less each month, which means more of each payment will reduce the principal. This concludes the ACLET Notes Payable Installment Note.